The Chicago Fed labor market indicator. It's a new thing published. It's out this morning. It's a new report that brings together a lot of different alternative market indicators along with the government data, but we don't have the government data. So this indicator is now filling in for the missing government data with other private sector data. It's confusing. You can read it online, but the bottom line is this. Estimates the unemployment rate most likely unchanged at 4.36% in October, but there's a 40% probability that it's higher according to the model and a 20% probability that it's lower. Joining us now, Austin Goolsbee, Chicago Fed President and former chair of the Council of Economic Advisors in the Obama administration. Austin, I know what I'm doing this weekend. I'm going to play a little guitar. I'm going to do a little fly fishing, spend the rest of the time trying to understand all of the alternative jobs data that's out there and just what the heck it's telling me about the market. So we had this morning, challenger job cuts, one of the worst Octobers since 2003. We had the ADP report, 42,000, that's okay. And now I've got this report telling me that the unemployment rate probably unchanged. What's your take on the job market? And good morning.
Well, hello, Steve. I'm going to save you some time this weekend. You just move the Chicago Fed labor market indicators right to the top. You look at it, and you just saved yourself 30 minutes. We have only the private sector information when the government is shut down. That said, when we put together these labor market indicators, it wasn't because of the government shutdown. It was because we wanted more real-time information, and so we supplement by 11 different sources. And to me, most of the labor market indicators that we're getting show a lot of stability in the market. And when we were getting the government data, they showed a lot of stability. The one number that was not showing stability, that showed pretty substantial deterioration, was total payroll job creation. But there's a question mark on that we should be a little careful over-indexing on payroll job numbers as an indicator of the business cycle. When immigration, there's a huge question mark, and you don't know what's happening to population growth. So I still think there's mild cooling, but this labor market indicator reading that we put out from the Chicago Fed that shows the unemployment rate is basically unchanged except for a tiny increase that came from the workers who are not working because the government shutdown. And that the hiring rate shows a lot of stability, and the layoff and vacancy rate also shows a lot of stability. That's what it feels like on the labor side so far to me.
Okay, there's a different way to look at it, which is not what does the numbers say now and what was it before and how the change is, but where the risks lay. And what do you say in terms of the downside? Is there greater downside risk to the job market? And how does that compare with your assessment of the risk when it comes to inflation?
I'd say a little. I'd say there's a little more danger. It feels like mild cooling. The hardest thing that is among the hardest things a central bank has to do is to get the timing right when there are moments of transition and try to figure out the through line of what's happening. That's why I still continue to think that there's a lot of stability. And we're in an unusual environment, which is this low hiring, low firing environment. The beginnings of recessions and business cycles are not historically low hiring, low firing. There tends to be low hiring when there's high firing, or when the economy is booming, the reverse. It characterizes periods of high uncertainty when businesses pull back and they have both low hiring and low firing. And when I'm out here in the Midwest talking to business people in the Chicago Fed district, I still hear a lot about that. We don't know what the rules are going to settle down at. We might still get deals on tariffs. We need to figure out where we are before we're going to reach an equilibrium. So I think there's still that uncertainty hanging over us.
Does that uncertainty and that lack of understanding where the equilibrium is make you reluctant to continue the rate cutting cycle that the Fed appeared to be on?
Maybe. I mean, I think there's a subtlety that is asymmetric when you turn off the data like we have. And that is, we have a bunch of indicators from the private sector and from the Chicago labor market indicators, et cetera, about the job market. And we have very little private sector information about inflation. So when the government is shut down, we're not getting the official statistics. If there are problems developing on the inflation side, it's going to be a fair bit of time before we see that. Where if it starts to deteriorate on the job market side, we're going to see that pretty much right away. So that makes me even more uneasy, maybe I'd say, with front-loading rate cuts and counting on the inflation that we have seen in the last 3 months to just be transitory and assume that they're going to go away.
Mr. President, what are the indications or the worrying parts of our current situation that would cause us to think that the labor market is softening? And by that, I mean, I know we've had tariffs. I'm not sure that's really enough to do it. The uncertainty from tariffs and what that does to businesses, maybe that could play into it to some extent. But you look at earnings and you look at the stock market and you look at things like that, and I'm trying to figure out why we would even be predicting that jobs would be weakening. We could be totally wrong.
Jobs would deteriorate. It's an interesting question, especially when we're getting the GDP numbers coming in as strong as they are. Consumer spending strong, and if growth is that strong.
Look into the abyss. There's nothing there, unless maybe AI is putting people out of business or something.
Yeah, but look, you could have in the short run, if technology and productivity growth accelerated even more, and it's been pretty high in the last 2 years, if it accelerated even more in the short run, that might replace their need to hire labor. But that really wouldn't be the business cycle. I think it would have to be, you've seen this cooling. The hiring rate is pretty low. That's the weakest part of the job market. And everyone knows that and feels that. If you look at new graduates especially, they're feeling it's hard to get hired in a job. And so the deterioration of the job market, if it weren't sudden, if it were tied to consumer confidence, where you've seen consumer confidence hasn't been that high, maybe it would be rooted in that. But I think there's been a lot of stability in the job market, and the unemployment rate is objectively low, and the layoff rate is objectively very low. Both of those, that would be very unusual for the beginning of a recession.